Hi students. Well, in this example we're going to continue looking at leases from the lessee point of view. We're also going to look at a slightly more complicated example because in this example we have a guaranteed residual value. Plus we're going to use the financial calculator and Excel to calculate the numbers that we need as well. So a little extra in this one and a little more perhaps realistic that you have to figure out some of this on your own. So let's look at the lease that we are signing up for. We have a 5-year lease term. The interest rate is 7%. Payments are due at the beginning of the year and they are $25,000. And we also have a guaranteed residual of $20,000. So the first thing that we need to do then is calculate the present value of the lease because here it's not given to us. Now just to note on the interest rate of 7%, this could be the lessor's rate. If we know the lessor's rate, we use it. If we don't know the lessor's rate, then this is our incremental borrowing rate. But in either case, we need to calculate the PV of the lease. So maybe the best way for you to do this in practice would be to get out your calculator and do this along with me on the video. Now, let's look at the inputs. We have a 5-year lease. So we're going to key in 5, and then we're going to hit N. The interest rate is 7, so we're going to hit a 7 and key in interest per year. Now just a reminder about the sign convention on your calculator. You'll see that I've keyed in these items as a minus, and of course that's because it's a cash outflow. You give the lessor $25,000 a year, and you also give at the end $20,000 worth of equipment or cash and equipment combined. So if you put these as a minus, indicating an outflow, then your present value will be positive. So let's do it that way. Key in 25,000, hit the minus key, and then payment, and then key in 20,000, minus key, and hit future value. Now before we hit present value, what about the beginning of the year? Did you set your calculator to begin? So just a reminder, if the payment is due at the beginning of the year, you need to set your calculator to begin. Hope you did. If you did not, you probably need to clear your calculator and start this over with your calculator at begin. If you did, all you need to do is hit the present value key and you should get this carrying value right here. That's the number that should come up on your calculator, and that's the present value of the lease. So now let's look at how to do an amortization schedule, and this is maybe especially appropriate because we do have a guaranteed residual value. So I've done the first little bit here, and let's do the rest together. And you could do this on Excel at the same time if you want. I mean, I think you will get a little more out of the video if you were to open Excel and do this on your own. But here's our beginning amount. Now remember, our first payment is due on day 1. There is no interest on day 1. You haven't incurred any interest yet. So the whole $25,000 comes off the principal of the lease. So we're looking at $98,940. Then a year goes by. So interest is at 7%. We're going to pick up this. And we're going to multiply by 0.07. And that's going to give us our interest for 1 year. So that means that the amount of decrease to our lease liability is there at 18 and a bit. And we can take that and decrease it. So one thing you may notice then is that this is a formula. I've keyed this in as a formula, and if you use a formula, then you can just drop this down. Now notice where I'm dropping this to. It doesn't look good right now, but here is the lease liability after your fifth payment. But remember that your fifth payment is due at the very beginning of year 5. But you don't give the equipment back until the end of year 5, basically the beginning of year 6. So remember that $20,000 residual value. At the last payment, this still shows that you owe $18,692. So this is where you need to be careful. Don't get worried. Don't get confused. The $18,692 will turn into zero owed as soon as you give them the $20,000. Now I know this looks a little weird on the table because I copied that formula down and I don't have a payment here. It says I owe 20. Okay, but watch what happens when I key in the payment. There's my payment. I pay it and I don't owe any money. So that is, again, the same interest formula. I just charged 7% on this balance, took the difference, and that paid off my lease. Okay, so you can play with that on Excel. The key advantage here is that you have all of your numbers that you need to do the journal entries for the full lease. So let's have a look at depreciation. And you may recall from the first video or from your other reading that if you have a guaranteed residual, then you're going to treat it when you calculate depreciation just like you would a residual value in equipment you had purchased and you intended to dispose of in 5 years. So we're going to take our beginning lease amount, we're going to subtract our guaranteed residual, and this is the amount to depreciate. And of course, this is going to be over a 5-year term. So $20,788 per year is our straight line depreciation amount. So let's look at the journal entries now. And to set up the lease, I mean, in theory, you certainly could do a combined journal entry. This is maybe a little clearer because it starts the liability at our beginning amount. So I've done this with 2 journal entries, both, however, January 1, year 1. So debit your right of use asset. Notice that the account title is right of use asset, not right to use asset. I just get that sometimes from students when they write in the account title. And credit your lease liability. So here's us owing $123,940. The very same day, you reduce that lease liability with a cash payment, which means that $98,940 is where it's sitting right now. So on December 31, you have incurred a year of interest. However, you're not having to pay that until January 1, year 2, like the next day. So we have to accrue our interest expense for the year. Now the debit is to interest expense, and that is the number from our table. And therefore, every December 31, you're going to have the same account titles, except the amount is going to be different for every regular payment, right? But you're still going to accrue your interest expense. Now, there's a little bit of wiggle room here as to whether you credit lease liability or you credit interest payable. I mean, I think that technically it is interest that you owe, so it's probably technically better to credit interest payable. However, you may choose instead to credit lease liability. So if you credit lease liability, you're just bumping your lease up that much more. It just means your January 1 journal entry is a little easier, not a big deal. So we're going to look at that. Then we do our depreciation expense entry. We already calculated that amount. Now you'll notice that your depreciation expense is the same every year. It's straight line depreciation, and in real life, you're going to do partial year depreciation because you're not just going to lease everything January 1, but that's okay. Okay, now what I've done here with this second $25,000 payment right here, that 25, is I've assumed that we credited interest payable. If you credited interest payable December 31 and you're paying it off January 1, then you debit it, and the difference is your lease liability. Now, I do kind of like this. I know it's just one extra account title, but if you notice, your lease amortization schedule gives you those numbers right there. And these two numbers here turn into the reduction of your lease and your interest payable. Now, I'm going to change this entry right now. If I had originally credited the lease liability here on December 31 and not created an interest payable, then my lease liability would be a debit of $25,000, and there would be no interest payable, and that would be just our entry. And it is simpler, right? No question about that. So these are the basic entries here. Other than setting up your lease, these two here are your end of year interest accrual and depreciation expense. January 1, you pay the money. That's just going to repeat itself again and again and again. So there we are. I'm not going to do the journal entries with you for 3 more years, but you just fill in the numbers table. The journal entry titles are the same. So that brings us to the end of the lease. And I think, and maybe it's more important for us to look at what happens at the end of the lease. Now you're giving the equipment back. And if you had purchased this equipment, that would be equivalent to you selling this equipment for the residual value and trying to get your $20,000. Very similar. When you don't have equipment anymore, you have to remove the asset from your books and remove the accumulated depreciation. In this case, you have to give back equipment worth 20 or a combination of equipment that's not really worth 20 and cash. So let's say that at the end of the lease, your equipment is only worth $17,000. So you've agreed with the lessor, and you have to pay the difference to 20. So you have to pay $3,000 cash when you finalize this lease. So we're going to do 2 things. We're going to pay the money. Well, 3 things. We're going to make the final lease payment. We're going to finalize the lease, and we're going to take the asset and related accumulated depreciation off the books because we don't have it anymore. Now that sounds a lot more complicated than it is. The journal entry itself is pretty straightforward. So the difference between the $20,000 guarantee and the $17,000 value is 3. So that $3,000 is a loss on the lease. And you'll notice that it matches the cash credit that you have to pay. So that part of your journal entry is pretty easy to build. Now you'll notice from the table, I'm going to scroll up here, you'll notice that if we take the $18,692 and we add the yearly interest, you owe $20,000. So we have to pay that $20,000, or you actually have a lease liability sitting on the books that you haven't taken care of, right? So we're not going to finish this lease and leave a credit on the books of 20, right? So debit your lease liability, $20,000. Now, the equipment has gone. So this is your initial value. Credit out your $123,940 and debit out your accumulated depreciation. So if you remember your earlier courses, right here essentially is how you take an asset off the books. So all of these come together And like I said, we're doing three things. We're recognizing our loss, we're removing the liability, and we are removing the asset and the associated accumulated depreciation. And of course, to do that, we had to pay cash. So that's quite a bit more thorough example on the lessee side. And the only thing that we could do to make this even slightly more complicated, really, is throw in an executory payment, something like prepaid insurance for the year, or maintenance expense or taxes. But in the end, that wouldn't make much difference. So in the next video, we're going to look at a lease and journalizing a lease from the lessor perspective.